Welcome back. Welcome back to Trend Following Trading Ideologues, Thursday edition. I'm always on vacation, right? So of course, traveling a bit and fishing. This is a week of fishing in Southwest Florida, and I pretend I like fishing, but I kind of go along with the guys on the fishing thing. It's kind of fun, I guess. But yeah, tomorrow's a no-go. So thanks everybody for being here. Hopefully we get some of the regulars here today. Got a lot to talk about. A lot of good tweets yesterday. Druckenmiller, that was kind of fun. That was a lot of people love Druck, and I like him too. He's a very interesting guy. I don't know of anybody with a better track record. He said it's audited for sure. So wow, 30% for 30 years, no losing years. That's pretty good. I got nothing bad to say about that. It's the proof's in the track record, and he sounds a bit like trend following. Every now and then, or he says things we kind of like every now and then. We're like, yeah, kind of a trendy guy, chart guy. Not totally, probably, but a lot of stocks, of course. We missed out on the stocks. Managed Futures misses out on stocks. But a great, and Soros, what a guy to work for. I mean, Soros, Richard Dennis, wow. Yeah, amazing traders, amazing ability to not get freaked out by the markets. Yeah. Okay. So let's put our heads together on what we want to talk about today. Compounding. Druckenmiller. Going through my tweets here. Oleg, are you ready? Are you a speaker?
Yes, I'm a speaker. I'm very happy to be a speaker because a lot of program issues with this trading for with these rooms for maybe 3 or 4 recent months. But anyway, I'm very happy to be part of this our trend following trading club because trend following trading is one of the most important things for me. And so, good morning, good afternoon, and good evening to everyone. And I'm very happy that this week I was waiting not 7 days, but 6 days for my favorite conversation. So I was thinking a lot about our trading issues, some different things, and in the recent episode we were talking, and I have heard, but I could not speak because of program issues about profit targeting, and I want to say that it's not. I wrote this that it's not our trend following philosophy, because yes, in short-term space, especially sometimes profit targeting look good, but we can miss a lot of movement, a lot of outliers someday, and it will be critical. And of course, not so critical in short term and more critical in a long term, when the regime will be changed and it will be trending environment. Profit targeting is not the best decision. So here are my thoughts that I wanted to say in the previous our conversation. So let's get started, and I'm very happy to be here.
Thank you, Oleg. That was great. When I was a kid, I used to watch this TV show, and it was like my favorite show of all time. Kind of like Oleg's favorite show is Our Spaces and Batman. It came on Tuesdays and Thursdays. Tuesdays and Thursdays. What a great idea. 2 times a week. So maybe that's in our future, Oleg. 2 times a week. I don't want you to have to wait even 6 days, maybe. Maybe we'll change it around. But you do get some, 30 minutes of Mike and me, and we're going to record that podcast right after this. So, and the interview I did at CMT, I think that video came out past couple of days. So maybe people have some comments there. But one of the things I found was kind of interesting about Druck was this is sort of typical of global macro hedge funds or hedge funds in general, and that is, loading up on a trade. You got to load up on that thing, You see that fat pitch, you hit it. You may take a small loss, of course, but they're really big on the loading up thing and putting a big position on. And so I kind of do the opposite. I keep adding and adding markets so I can trade each individual trade smaller and smaller. So it's quite a bit different from what those guys are doing. Good morning, Josh. How are you?
Jerry, I'm great. Thank you for having me again. I always love hearing Oleg to start us off because it sets the tone. It sets the tone. It makes me worldly and thrilled, which is a great double header. I was just looking at my single stock experiment, Robinhood, my $1 entry fractional experiment, and I'm up as of last night 12.6% since in my open equity. But then I've had this shock because I did the audit. I look back and I'm down 46. I'm down $57 in the closed equity. But I'm rocking it in the open. So I'm like, well, I should give up and I have to change my metrics. And then I listen to you and Mike talking. And I'm like, stick with it. I'm not even in this a year. It's been September. I don't even really have any breakout profits closed in this scenario. So, stick with it. That's where I'm at. Thanks, Jerry.
Yeah, that's very important. You got to stick with it. You got to stick with it. Be disciplined. Follow your systems. You're going to give up at the exact wrong time. And I would institute over the years when I traded larger, and when I was just trading larger or too large, and I would have to take these equity cutbacks. That I would do it exactly the wrong time, but as soon as I would cut back my positions to preserve capital, I would it would be the low of the markets, but you've got to kind of ignore that sort of stuff, and I think all traders realize that because we've all been crushed by not following through, especially on the long side. If you don't, on the entry side, if you don't take a trade, you're kind of left out to dry. The risk reward is all wrong. Not taking a trade, anything can happen positively, and very little can happen negatively when we cut those losses short. Yeah, it's great to start with Oleg. He loves trend. He knows a lot about trend. He's been doing it for a long time. He gets me excited as well to get going, and keeps us all on the right track. I appreciate that. All right, who's next?
Hi, Jerry. How are you? Can I ask you a question? You mentioned about the way you are constantly adding new markets, so you reduce your R. Was that something that take you a lot of conviction to make? Because I'm kind of stuck, so to speak, on the 50 markets mark. And when I think about going your way, Richard's way, I'm always afraid of losing those smaller trends. But and I'm always thinking, okay, if I reduce the number of, or I reduce my R too much, there are some nice trends that won't move much my equity, right? Because now they have a smaller R. And I know that you are saying, on the contrary, there are more outliers now, so that doesn't matter. But did it take a lot of thought to change that? And do you see that sometimes your equity curve get kind of stuck because you're having nice trades but they don't move much your equity? Thanks.
Yeah, that's a good point. Well, I think what took me a while to get comfortable with was that there was no place to go except for adding more stocks. I'm maxed out. I've got a couple more currencies to add. They're just in long-term trends, and I'm waiting for, the breakout in the other direction. So I've got a couple more currencies, a couple more bond ETFs that I missed on the downside that I need to get in, but then I'm going, and I'm almost maxing out on my my stocks with my target of 300 markets. I'm in the 290s now. I don't have many more to add, but you just have to bite the bullet and I had to convince myself that okay, I can find enough stocks that are going to have a diversified position. So I'm not going to be all long or all short. So I feel like that I can get a lot of diversification out of the equities. I mean, I'm going to get stung possibly when, and I have been I've had that experience where I think it was 13 or 14, I made a ton of money in stocks and I was long every single stock that I had. I traded 100 stocks. It was the S&P 100. And this was the best year ever, like for this S&P 100. And so I made a bunch of money and then it kind of had a big drawdown all at the same time. But okay, I still made money. But you take a period like COVID where all the stocks went down, I'm going to get hurt in that period because there was really no profits to speak of on those trades. But then everything else went down as well. But, hopefully most of the time where we get shocks to the stock market, I'll be long and short and flat. It's very important to have this fixed universe. So you don't continue to feed these longs because you can just always be 100% long, in your risk budget for stocks. So it's very important for trend followers to have a fixed universe. So, you will have some shorts and flats, hopefully, when the correlation goes to 1. But it is going to bite me one of these days. I'm sure that I'm going to have underperformance because I have more stocks on long than anyone else. I don't have a lot of shorts. But the fact of the matter is, you got to always think about one thing, and that is you're probably going to get somewhere between 5 and 10% of your trades are going to be outliers. So you're always you're going to get those outliers, more outliers, but each individual one is going to be smaller. So I don't know if you're going to get more outliers by trading more markets. You are because of the 5% rule, but you're going to be trading them smaller. So they're going to be really small losses. And, it's going to have to really go a lot for any individual stock or individual market to be meaningful, but you'll get more of those outliers and it kind of works out to be the same, but you'll have more diversification, smoother performance, less headaches. I remember a few years ago, I was trying to really focus on correlation and really try to find the perfect portfolio as it relates to correlation, not emphasizing hunting outliers as much. And I wanted to create this strategy that really never gave me any problems. And it was always going to be this perfect correlation, and it was going to really allow me to sleep well at night. And then I realized, well, it's kind of not possible. You're going to let these profits run. Therein lies your problem. You're going to let them run. They're going to have some big volatility. I'm not going to scale back based on volatility and correlation. So I'm destined to have issues with sleeping well at night all the time. But I think I got pretty close to it by just saying, screw that, trade 300 markets, try to find a diversified as possible portfolio. And that's the way to go about it. So if you lose, I take a pretty healthy stop loss, and I still only lose 12 basis points per trade. And it just takes a lot of damage in the markets for me to suffer a great deal. And not saying it's not going to happen, but I was pretty surprised to be pretty much short every single interest rate possible, futures, plus short interest rate ETFs, and not vol manage. And I had minimal damage in March. I mean, I'm knocking on wood because that's not going to, next time I'm sure it'll be way worse for me. Everyone's going to have their turn of really sucking and being underperforming over a month or a few months or whatever. So you just got to be ready for that. But yeah, I just remembered, I was talking to one of my turtle friends this week, and he's an investor, and I was explaining to him how I've evolved a bit over the years. And I told him about this, we got to talking about correlation and diversification. And I said, remember, we were never taught to obsess with diversification. Um, we set the portfolio up initially to be diversified. But look, if we had a bunch of currencies on and we were all going to lose a lot of money, so what? We were hunting outliers. So I thank Richard for helping me, reminding me of that, because I just got sucked into managed futures and listening to other people talk about the need. If you're going to trade a lot of markets, why aren't you more diversified? You have on too many currencies or too many of this or that. And I started thinking about that, and you can get really bogged down into that and lose your sight on hunting those outliers.
Yeah, great. I agree with you, and I agree that you will suffer less in a downturn, although your draw will probably be in the future as everybody else's. But no, it's just I was like you on a turtle mind and said, okay, 50 is enough. And the good thing about 50 is that if there is a nice, not a home run, but a nice trend, it will really add to your equity and to your P&L, which in turn, if you have 300 and a good or very good trend, but not a perfect home run, it won't add much. That's something that is something that keeps me from adding more markets. It's like, okay, when things are doing good but not great, will I get diluted by having so many markets? That's something that it's in my mind all the time. It's like something that I remember a trader who called. He was discretionary, and he said, "Okay, we don't do PlayStation trades." He said, PlayStation trades were ones that were small, that they didn't grab enough attention, or they were, so small that it didn't make a difference. But I know that when outliers come, it's great to have much more markets. It's just the phase when the market is not doing so outlierish, so to speak. And I always thought that if you have 300, it's worse than having 50. But it's just something that I never proved.
Yeah, no, I don't think so. I think once again, actually, the more markets you trade, and the more diversification you can get, the larger you can trade in general. Your risk budget can go up a bit. There's certainly going to be, like last year was a perfect example of, everyone was going around talking about, and they still do, last year was the greatest year of all time for trend following. Well, these guys who say that, they had on a lot of bonds. They had on too many bonds. They were making 50, 60%, and then, took the big drawdown in March, which is fine. But it wasn't the greatest year for me. Heck, 20 and 21 were even better. And so I think if you have these concentrated positions, and were there outliers in those bond shorts? I think it was mostly just a big sector move. You could probably say, depending upon your system and your look back, everybody's the size of the moves for that can be classified as an outlier is different for everybody. But I would say for me, it's 50 ATRs. Okay, so were there any 50 ATRs in that group of interest rate shorts? Probably some of the short-term interest rates, the Eurodollar, short sterling, Euribor, bank bills, and bankers' acceptances. Okay, so some of those have changed names this year. But okay, so probably because the ATR to entry was so small. And so you put on this gigantic position, and it probably turned into maybe approaching that 50, 60 ATR move. But for most of the traders, managed futures guys, they scale it back anyways. They're going to get rid of that outlier outperformance because the ATR, the volatility was increasing. And so they, by definition, what they're doing is sort of sector moves anyways. And, they'll scale back the OJ, the great move in OJ and sugar. And so I think I lost my train of thought. But I think, yeah, you're going to get these outliers, and you're going to get these big moves, the sector moves, and you can trade a bit bigger if you trade 300 markets versus 50. But the math is the same. You're still going to get a certain percentage of all of these moves, and now you're applying that same percentage to 300 versus 50. And if you're worried about not making as much money, then you can trade bigger than guys. Your risk budget overall can be bigger than guys who only trade 50. That's my opinion. What do you think?
No, I think you're right. It's something like like a primal, so to speak. I think that when trends are not great, and of course my mind is playing tricks in terms that I'm like thinking maybe the future won't have as good trends, which is a mistake to assume. But I say, well, if trends are not so great, then equity curves will be more plain, and all the P&L will come in very short periods of time when all these outliers come to be realized. And of course, if more outliers come in the middle of it, it will be the same, and you will be more diversified, as you said. My worry, and again, I didn't prove this, so I'm speaking just about a feeling that I have, is that equity curves will be more lateral for a lot of time, and then they will have huge increases, and that's harder for governance, especially if you're managing other people's money.
Well, I tell you, I really enjoy being in the middle of the pack all the time. And I think that on these these months where we don't make a lot or lose a lot, I want to be in the middle of all of that, or even especially in the months where we do lose a lot. And so I'm just got so many things moving around 300 markets that I'm pretty happy to be in the middle of the pack, not doing too much, not doing too bad, not doing too well, not doing too bad, just hanging out in the middle. Leave me alone. Don't look at what I'm doing. Don't concern yourself with needing to redeem from me. So I think the one big kind of risk I'm acknowledging here, you guys are going to call me out one of these days, rightfully so, but I'm acknowledging that risk right now, and that is, why do you have on so many stocks? And I think that I'm trying to dodge this bullet, and I'm trying to say to people, you can get a lot more diversification, long and short equities, than you can in any other sector. Equities deserve that that more than an equal share of your portfolio risk budget. But one of these days, just like trading a lot of currencies, or all the currencies were one way last year, all the interest rates were one way last year. Stocks, you could do long and short. There's plenty of longs and shorts out there with a fixed universe, not forcing it. But yeah, so you just got to keep. But every great idea, every good plan, even the best plan, is going to have some bad periods. Hello, Alp.
Hello, Jerry. Hi, guys. It's good to hear from everyone else on a Thursday. Now, I'm the kind of a antagonist in this group. Everyone else is a long-term trend trader. I'm a short-term guy. So when I start to speak, some of the things that I raise could be challenged, and so be it. If there wouldn't be enough differences, there wouldn't be a market, wouldn't it? Now, so one of the challenges of trading stocks is, how much risk you're gonna allocate in your risk budget. How much you're gonna allocate to stocks and how much you're gonna allocate to non-stocks. And non-stocks have all these commodities and forex and credit section of the portfolio. And I was discussing this thing with Richard, and I was suggesting him, he was using 10 systems or more, and of course, in my view, you can use as many as you want to. It's better to smooth out the curve, but there is an inherent benefit, in my view, to allocate money to the system that is making more money. So if there is a obvious system that makes more money, let's allocate money. Means that, okay, if we have a 20% risk budget, then let's give a little bit more weight to the system that is making more money. But then I thought, okay, hang on a sec. So these are all long-term traders. The question is, are there going to be enough sample size? Is this going to be robust? So that's the question that I'm raising. For instance, Jerry Parker is allocating the equal weight to 4 of his systems, and I think that's a sensible. And I think I would have done the same if I wouldn't have enough sample size, and given the long term sample size, I think I understand that he's not doing it, and Richard is not doing that either. So I think that kind of makes sense to me. But in my way of doing things now, I would like to allocate risk between the stocks and the non-stock part of the portfolio. And now I know that this is going to be a little controversial in this group, that no one does that or raise this, but that's what I wanted to do. So if the non-stock part of the commodity is making money, so I can give a little bit more risk to that part of the group. And if the stocks are making more money, I can risk a little bit more risk to that group. And I can do that because I'm a short-term trader. I do have the benefit of the sample size. So I do have enough sample size to be able to justify it anyhow. And it is very easy to determine when the stocks are making money and when the rest of the portfolio is making money as well. So here you go. I said it. I would be keen to hear your views, Jerry, and from Richard and from everyone else too. Thanks a lot. Cheers.
Okay, I think I know where you're going, and I think one of my mentors was out the past few years saying that, contrary to what I think they used to say, was that there is enough data for them, and they're sort of short term now. There's enough data for them in the commodities that now they will trade the commodities with a different different systems. And because now looking at commodity, yeah. Now I would try to resist that idea. I mean, I guess, do we ever have enough sample size? Do we have enough? Is more better? And then, the fundamentals of turtle trend following were that in order to get the sample size necessary, you needed to trade all the markets the same way, longs and the shorts as well, and assume that it was almost like one market. Like don't even think about in any market or any individual sector and optimizing on that, because you need to close your eyes, pretend that all of these markets are kind of the same or like the same market almost, and gather up the sample size of trades. And from doing this back test, and don't say the longs are better than the shorts. We know that they have been, or that the yen is the best of all the currencies, crude is the best of all the commodities. All true, but we can't look at it that way. When you look at your trade stats, your average win, your average loss, and your average trade, it's all about looking at the entire group of trades. You cannot make these distinctions between markets and sectors or longs versus shorts. And so what I think you're saying is you left all of that out by just saying sample size. And then you say, I feel like with short term, I have enough sample size, recognizing the issues with maybe a long-term trader, that they're just scrambling for more. They don't have enough. We don't have enough, probably. But you feel more comfortable with this idea that, with short term, I have way more, thousands and thousands per year. We have thousands and thousands over 20 years. And so you feel comfortable by looking at looking at things more granularly and more specifically as it relates to sectors or markets, and so I think, yeah, I mean, I'm not one, I can't really say don't do that, but I I would resist doing that, certainly for my strategy. Did I get close out?
Just to clarify, so I'm running universal parameter set, Jerry, like you do, like 200-day breakout. So the parameter set is the same. So what I'm planning to do is just change the risk allocation between 10 basis points to 15 basis points. So instead of risking 10 basis points on both stocks and commodities, I am saying that if stocks are making money and if they are in bull markets, then I'm going to risk 15%. And I'm going to reduce the rest of the portfolio from 10% to 5 basis points risk. And I'm going to increase so I'm just going to shuffle the risk just tiny bit, not a lot, but just tiny bit. But everything else is the same. So it's just numbers games, universal parameter sets. I trade all the markets the same. So all the markets the same. So there's no change. I don't think that there's anything else different than our usual universal parameter set idea, but the risk allocation is a little bit different. And that's where I was saying that I do have enough sample size to both regimes where stocks are making money and they're in the bull markets, and the commodities, forex, and credit are there in their respective bull markets. So I can, instead of risking 10% flat, so I can just make it 5 to 15 depending on which side of the portfolio is running. So I think I'm saying is I'm seeing this as one portfolio and trying to allocate money by increasing the risk a little bit more, but everything else is universal. Thanks.
Gotcha. Yeah, right. Okay, but that's now is that are those rules and this idea based upon looking at the equity curve in the back test?
So this is basically I'm saying that I'm saying that I do have a method of identifying the bull market for the equities, let's say, whatever is your method. And I do have a method of identifying where the rest of the portfolio is in bull market. Okay, it's a simple. So I've designed a simple switch. Let's say, okay, like an electrical switch. So if it is on, then I am just risking. If it is a bull market, let's say you're in 2003 or 1995 or 2009. Okay, take whatever. So the stocks are just going like crazy. And in an environment like that, when I can determine it with sample size, with a very simple rule, I'm going to increase my risk allocation per stock from 10 basis points to 15 basis points, so that I can take a little bit more risk, and if things got sour, I can cut my losses short. So I will be losing 15 basis points instead of 10 basis points. And to be able to keep the entire risk budget the same, of course, I will be reducing risk from commodities and the forex and the credit when this thing happens. So what is the implication of such an approach, really? Nothing. Everything else is the same. It is still the same breakout. It is still the same trailing stop, but I will be juggling tiny bit of risk depending on what is happening. Does this answer your question, Jerry?
Right. Yeah, I get it now. So does it have anything to do, though, with sample size? Really, couldn't a long-term trader come up with this same idea?
Yes. You can identify the bull market, but your sample size is always kind of much of an issue, isn't it? How many trades you're talking about? 5,000 trades? Yeah. That's why, I can make 5,000 trades per year. So So you need to be justified, I guess, in the sample size. That's all. That's the only catch. Otherwise, we've already discussed it with the Richard. I mean, Richard is, someone else. If I would be running 10 to 100 systems like Richard does, I would definitely edit this thing into my portfolio. But because he's a long-term trader, I'm not quite sure whether he has enough sample size. Richard, are you there?
Yes, Al, I'm here just listening. Look, the way I address it is I use this ensemble of systems. So at the moment, I'm trading 10 systems, and but the reason I'm equally allocating to each of those systems. So the process I adopt, I tend to avoid putting things into asset classes or groupings. The way I do it is I'm looking for this universal feature called tails. I know that they can be found in any liquid market, so I'm not therefore classifying my returns into buckets like commodities, um, shares or equities, bonds, all of that sort of stuff. What I'm doing is I have basically the proposition that each of these return streams that I'm looking at has a potential to deliver outliers, whether or not you can see that in a historical record or not. Because I'm sound with the science behind the theory, I have implicit faith that my systems, if outliers are present in those markets, my systems will capture those opportunities. So I use an ensemble of systems, effectively of equal weighting, because I don't have any preconceived notion that any of those systems is going to do better than any other system. All of these systems have gone through rigorous hoops in that, one, they all are applied across all markets of my portfolio, and they have equal validity, even though their performance may differ. When outliers present in those series, I notice that these systems catch those outliers. So because these outliers, to me, are very difficult to decipher, they're anomalies that have many different forms and patterns, I'm not having any preconceived notion that any of my systems is going to do better than another. The reason I'm using an ensemble of systems is to reduce the correlation impact of investing 100% of your effort in one system. So in other words, if I was trading all of these, say 60, 70 markets or whatever, with one system, you'll find that the trade results are going to be far more highly correlated than if you trade those 70 or 60 markets or whatever with 10 systems at 10% allocation each. In other words, I'm going down to the smallest possible bet size I can, using diversification principles, and I'm not investing 100% of my effort in one system. I'm trying to spread it. I'm trying to allocate it to 10. The reason I'm doing that is that these outliers have these many different shapes and forms, and if you invest in one single system, you're going to find that, lo and behold, several of those outliers are going to be thwarted because you're whipsawed out of that by the configuration constraints of a single system. When you're applying an ensemble of systems where you have no preconceived notion that one's going to do better than the other, you're equally weighting, allocating equally. The whole principle of doing that is, one, it breaks down correlations to a single market. That therefore allows me to trade Brent and crude, because I know that 10 systems applied to each is going to produce a less correlated relationship than one system applied to both. That's a major reason why I do it. And the second reason is because by investing across 10 separate systems, you've got much greater opportunity of not stuffing up when you're on that outlier, and some of those systems are going to hold. Some of them are going to be whipsawed out and they'll re-enter again. Others will hold the entire duration. What I've found over my back tests is that it's that small variation between those that hold through its majority of the outlier move, to those that are continuously whipsawed out, have to enter, whipsawed out, have to enter, etc. When you do that, you realize that an ensemble of systems is a much more efficient way to capture as much of that outlier as you possibly can. Furthermore, what you find is that by using an ensemble of systems, as the trend matures, more and more systems become active. So you find that you slowly, progressively, with more systems, concentrate your bet as the outlier continues on in a favorable direction. If it doesn't, you're not investing, all of your systems at once. They're spread out throughout that entire process. I tend to find that as outliers mature, I become more and more concentrated, and that's exactly when I want to become concentrated, because the only thing I'm risking is my unrealized equity. I'm not risking my realized capital. The only time you risk your realized capital is on early entry into trends, if at all, because other aspects of your portfolio are going to be profitable. So, I find that the method, it is a bit like pyramiding to an extent, that you're progressively increasing your concentration as you progress in the trend. But it's different to pyramiding because no single system is the same. Each system is unique, and they're capturing different facets of that outlier with loose pants.
And and those different systems, they don't pay any attention to the other systems. They're on their own. They With the breakout systems, all 10 of them can get in on the same day, and then at the same time, at the same price. And then that's unusual. It doesn't happen all the time, or the majority of the time. And sometimes the breakouts are good at spacing in the entries and exits. I feel the same way. I think most of my systems, they're very similar, and they are highly correlated, except on the exits where you can get some differences on the exits. Sometimes the slowest one does get whipsawed, and then sometimes it gets out quickly, and it was a great place to get out. The first exit can be your shortest term system, can be very advantageous because the market just kind of crashes, and the slowest system ends up not making the least amount of money. And then the quickest system also probably gets in with a lower ATR on average, so it has the biggest position as well. Now, one of the things I wanted to ask Richard was, I agree with the way he started out talking about not really paying attention to those sectors. I think it's something like that. And then, okay. However, I would kind of say the same thing, but in the sense that I trade all the markets the same size. So my smallest sector would be something like the interest rates, because there's just not as many of them as the commodities and the currencies, for instance. So I'm going to trade that sector smaller. I'm not trying to evenly weight the sectors, obviously. But however, we have all talked a lot about needing more diversification and trying to minimize things that happen in like March. And so I absolutely, though, will look and say, for instance, if you trade equities, you're definitely de facto going to care about not overweighting your portfolio, because it can become 90% equities because there's so many of them, and you could trade all the currencies, all the bonds, futures, all the stock futures, and all the commodity futures, and it's going to be kind of really balanced. But if you're going to add in equities and try to get more diversification, 300 markets or whatever, you're going to say to yourself, well, you got to stop. At some point in time, you're going to say, too many equities. So I have to recognize that I could overwhelm the portfolio by trading every futures market, but I've overwhelmed it with 1,000 equities, and I'm really just an equity trader. So I think to that degree, we do have to take into consideration that you can go too far. You can absolutely close your eyes, like managed futures CTAs do, and trade all the futures markets, and then you could have this pretty well diversified portfolio, but not if you throw in stocks. Do you get my point, Richard?
Yes, Jerry. So just to explain the process I use, look, I don't have a preconceived notion of what should be grouped into classes to start with, because really that's an assumption. If I say that all commodities are alike or all stocks are alike, etc., it's effectively an assumption. I've got to test that. So what I do is that in the portfolio compilation process, I've got thousands of return streams of all individual markets, different systems, etc., that go into the compilation process. And the compilation process is looking at as much history as it possibly can, and it makes its decision based on historical correlations. So in other words, what it's doing is it's saying, here is, let's say, 1,000 return streams. We don't know what they are, but here are 1,000 return streams. Here are their results applied over a 30, 40-year history. They go into a big bucket, and then the portfolio compilation phase says, all right, now let's select a portfolio of, say, 150 or so return streams that together compile to produce an optimal uncorrelated result. So that process, therefore, it's not using a preconceived assumption about what is correlated or not. It's using the history as a basis to make that assessment, and then whatever it produces, it might produce something. There might be. Well, I'm not actually trading single stocks, so it's a bad example. But let's say I was trading single stocks. Let's say, for example, it might produce 20 stocks that were fairly uncorrelated. It might produce 30 commodities that were fairly uncorrelated. It might produce 10 bonds or whatever. The process itself determines the allocation, well, not the allocation, but the composition of the portfolio through looking at the historical data sets, how they're performed across multi-markets, how they're performed across long-term track records. So it's just avoiding an assumption. And so if you could imagine with stocks, as you say, when stocks go negative, what you'll find is that when stocks go negative, correlations go to 1, you'll find that will actually be found in the compilation process, that the optimal portfolio cannot support so many stocks, but there's actually a factual reason in the process that is actually identifying that. It's not me coming up with an assumption or a statement. That's what I feel it's going to be. So I'm trying to let the data validate the compilation process or the technique itself, as opposed to any preconceived notion.
Yeah, that's better. That's the better way to do it. I agree with that totally. So essentially, Jerry might say, I'm going to do 50% stocks. Richard's just going to say, nope, let's feed the stocks. Let's feed stocks that meet our criteria, liquidity into the back test, along with the currencies, commodities, and interest rates. And let's see what the computer says. And it may say 25% stocks, 75% stocks, but we're not going to have this preconceived idea of, as a sector, stocks cannot be more than X percent. Yeah, your way is much better. I like that quite a bit. And I think that's absolutely the way to do it. I think that, I do think, though, that I am going to, even if it came back to me and said, you were so right, Jerry, you can get all of this diversification with equities, so make equities 75%. I think I'm just going to say, I got a business to run here. I want some diversification. And I think I'll just limit it to some degree to 50% so I can have some meaningful exposure in currencies, commodities, and interest rates. But I agree with you. Your way is the way to do it.
So, so I'm definitely having a slight tangent on this, isn't it? In this idea that, when we add the stocks, single name stocks, things work a little different because stocks move quite correlated during the bull market and during the equity during the bear market. So I think what I'm saying is, statistically speaking, it is possible to look into this data set that we compile to perform those back tests, and there is additional information on identifying market regimes. So that, I think that's what I'm saying, possibly. And once you identify the market regime as equity bull market, so in my back tests, it is clearly showing that there is a benefit in making that allocation to 50%. But when it is in bear markets, I see that it is very beneficial to use something else lower than 50%, something else between 25% to 40% risk allocation. So I think that's where that's the additional tangent that I'm having, which I'm saying I'm going to extract an information about market regimes because equity system is quite uncorrelated to the rest of the portfolio. So it's not like, if I would be trading the Chinese commodities, yes, I would have done exactly what Richard would have been doing it. And it would have made sense because it's more of the same thing. So it is just going to actually complement the existing portfolio. But with the single name equities, they are so uncorrelated to the rest of the portfolio. So it's as if there is two systems for me, and because of the large sample size that I do have as a short-term trader, I can see that there is a lot of benefits in keeping it 50% on bull markets, but really it doesn't make much sense while you're going through the 2000 to 2003 bear market. My results are getting better if I actually take some risk allocation off the table from equities and allocate it to the rest of the portfolio. Thank you.
I love that there's a world, our world, where these different ideas can coexist. Jerry Parker's 25% across 4 classes because of business interests. And Richard, everything's the same. Let's see the victors. Let the victors emerge. I just love that. Robust.
Yeah, just to be clear though, I'm going for more like 50% stocks, and because I think, and I think what happens is when you look at the back test, you can see that there will be times where these stocks are very uncorrelated. Some are going up, some are going down. You're long some, you're short some, and then there are other times where the market crashes. I think the key there is to do all you can with your portfolio of stocks to tilt the odds in your favor to where you'll have some shorts on and you won't be long everything. And I think that's what the data shows, that because when the rest of the world, like, did your stocks get crushed today like mine? Everyone's going to say, yeah, my stocks got crushed today. But then we say, well, but I was short a bunch as well. And that's all we can say. And so the trend following overlay gives much different performance than just long only. There was another tweet, I guess it was it TransTrend or Quantica, talking about negative skew of stocks and positive skew of trend following, but it was no comment on what's the skew of stocks with trend following. And I think it starts to look more like trend following the futures. So the whole world talks in this one language, assuming that you're long and you don't have a trailing stop, you're not overlaying anything with a trend following strategy, but that's what we can offer.
I saw that as well, Jerry. I was thinking that long only stocks, that was a buy and hold long only, wasn't it? It wasn't even trend following long. And as you said rightly, it was not only not trend following long, it wasn't trend following short as well.
That's right. And I think, just anecdotally, I'm not sure how I hear this a lot, assuming, there's this big question, does trend following work in stocks, irrespective of the few papers that have been written about the subject? But how do you go through a 10-year CTA winter, and the only thing that trended were stocks, and then the next thing you think about is, does trend following work on stocks? Well, for 10 years, it didn't work on anything but stocks. And so I think it's pretty obvious that, as we continue to say in this space, is that this is a property of all markets, this outlier potential and the results of seeing outliers in the markets. And, I've already said that, well, I build my portfolio based upon uh, liquidity and diversification. I got bounced out of my egg stock. Yeah, sad day. I got bounced out of my egg stock this week because it crashed. But my French fry stock is still doing well, and my perfume stock is my best performer. And then I like to do these small stocks and small companies, one story, one business line. But I went back and looked. When I made 500 ATRs in Tesla, it was a $50 billion company, and so I'm skeptical of all of these ideas. Oh, tilt your portfolio this way or that way to increase your chances of getting outliers. At the end of the day, none of this is that predictable, and you may see the exact opposite of what you think. I think in my case, the key to me in my trading is just be doggedly consistent all the time. If you're going to trade these small stocks, do it all the time, do it forever, and it'll probably work out okay. But I'm even skeptical of some of my own good ideas, especially when I can admit that there's a little bit of prediction here.
Jerry, you brought this to my attention this week. What did you think about TransTrend's bounce back after March?
Well, you were braver than me by putting it out there. And I saw that tweet. I saw your tweet last night, and it was like, speaking of TransTrend. And I'm like, who is speaking of TransTrend? I'm not speaking of them. But no, I don't think it's very difficult to understand, especially when the numbers are coming in, that it was a relatively small month, minus a few, minus a couple, plus a couple. I can't even figure out what moved enough. I don't know. Maybe the clue is in some of the things that they've said. Maybe they totally discounted that move up in the interest rates and used that as an opportunity to get short. With the managed futures CTAs, I'm never really sure how much trend following they're doing, but I can't figure it out. And with Quantica, they do the relative strength type of stuff. Maybe you could say, okay, maybe that was the generator of a double-digit return, but I don't know what TransTrend is doing. I do like Herald. I do trust them. And I think it's perfectly fine to lose 10% in a month. And obviously, it's pretty nice to make it all back the next month. But, then Winton comes out, and they're always coming out on these shows, podcasts, and talking about Sharp's no good, volatility is not risk, and pointing out all the obvious stuff. And then the next breath is something about volatility management. And I'm really confused about what they're actually doing and how they actually do things. But yeah, I'm glad. I don't like to talk about performance, especially negative, because it's just not good karma. But Richard, can you think of a way how did they get that amount of return from the
It
market
it's
action?
Yeah, it's flabbergasted me. I've got no idea. But what I think we do is we wait until we see the other funds report in for the month of April and see if this is the anomaly. If this is the anomaly, obviously there's something weird going on with TransTrend, because I just can't, we don't have the attributions, unfortunately, for TransTrend, but I don't know what could have contributed to that 10% increase. So yeah, let's see what happens with the other funds for April and see if this one stands out like the black swan.
Yeah, we've seen Quantica, we've seen Systematica. I haven't seen Done yet, but
No, I'm expecting sort of 2%, 3%. That's about it. I can't see a 10% rising from anywhere at the moment, apart from TransTrend.
yeah, the one thing about Harold too is I can never really understand what the hell he's saying. Um, but yeah, it's good. It's good to see somebody do really well and come back and get the entire industry back to being positive. That's always a good thing. Um, yep.
So,
Go ahead.
just to let you know, I'm following TransTen's LinkedIn posts for some time, and so they are big on alternative markets, and there are many posts over the months that they say, we trade this alternative market, and maybe that might be the difference. I'm suspecting, Hungarian florins or Hungarian interest rates, or something else other than the G3 developed market exposures. I'm assuming, yeah. Thank you.
I think that first of all, as a trend followers, we must stick to our core principles. And near a year ago, Niels said this in our conversations here in Spaces. That first of all, if you want to call yourself a trend follower, you must follow trend following rules and trend following philosophy. So, for example, I have wrote today in my comment on Twitter list that if a person do role management or something like this, or he predicts the market, he is not trend follower because he is not a trend following philosopher. I think so.
Jerry, in relation to that Drunken Miller post, there's a great post. I also really like that Morgan Housel you posted on compounding. But the Drunken Miller, like once again, we're visited by an investor, a bit like Howard Marks, a bit like George Soros. There are certain aspects of these great names that we can really appreciate, and there are certain things that they say, and one of the clear things is that they're counterintuitive investors. And personally, I think what we do in our hunt for these outliers is perhaps one of the most counterintuitive games of them all. And I remember last week we were talking about the psychology of trading, and I forgot to bring this up because I was thinking about it during the week. And I thought that one of the reasons that we need to divorce our attachment from our emotions towards a faith in our systems is that we are dealing in a very counterintuitive space where the price moves that we see, the price moves that we capitalize on are so counterintuitive in nature. And if we allow our brains emotionally to sort of override our rules-based decision, we're simply not going to get that edge that we're able to build from our systematic rules-based process. And it's a necessary accompaniment to the job that we do as outlier hunters to basically become robots, effectively divorce emotions and trade our system rules as the system rules that have been sort of honed over huge data sets that are basically smarter than what our brains can tell us. And I was just thinking, that's another powerful reason for why it's essential to have this systematic application. We've got vast diversification. We're trading so many different return streams. There is no way we can trade that in a discretionary manner for a first thing. We need our computers. We need our systematic processes. We need our rules-based process to totally eliminate emotions, trade small, very small bet sizes, look at our results over thousands of trades, not individual trades. It just all makes perfect sense when you recognize that we are trading such a counterintuitive game. And that's what I think we have in common with people like Druckenmiller, Howard Marks, George Soros, all of those. It's the counterintuitive processes we adopt. You'll notice that they all adopt processes. They're not interested in individual trades. They can list their successes on their fingertips, maybe 5 major trades in their lifetimes that have been, the fruits of their efforts. And in the same way that with our outliers, it might be, 10 or so outliers during the course of our careers that basically pave the way for our long-term success.
Yes, but Richard, when you're saying we need to divorce the emotions from the process, there's always the element of the machine where these systems are running, and then the psychology is the willingness to follow the system. And of course, we are committed, so this means that there is willingness to follow the system, but still my brain is coming up with all sorts of emotions now. And then the next obvious question is, when you are committed to following up the machine, and the brain is coming up with those emotions. How are you going to deal with those emotions? Because it's not possible to say that there is no human being who's not ending up with those emotions in a systematic process. We're just we are just moving those emotions upstream while because we are running these systematic processes. But still, when the portfolio starts to move up and down, there are emotions. You're getting into a drawdown, emotions are there. You're winning, the emotions are there. So how we address these emotions is just integral part of it, because we keep on following the system, we keep on being committed, and we end up with those emotions. And there are different levels of awareness around those emotions. I sometimes notice myself better in dealing with other people or dealing with myself in either circumstances, be it in a winning situation or in a losing situation. So really, I think it's not possible to say that it's not possible not to do any work and then run this trading program over many decades. In my view, things would be much more easier and healthier for the trader and people around that trader if you spend some time to address the emotions that are popping up while you're committed into doing the act of following the system. Thank you.
Yes, Al, look, I don't know whether it's because, I invest much more of my time these days in R&D. Whilst I've got my systems always actively trading, my mind's focused elsewhere. I don't know whether that's a deliberate ploy on my behalf, but what I have found is that, in the past, if emotions have entered the game and I have, on the fly, made decisions that have altered the course of the rules-based process that I'm applying, I inevitably find that it's a bad decision. I can list events over the last 20, 30 years or whatever that have just been significantly bad decisions made by me where my emotions have overridden my system. I think there does come a time where, over the course of time, where that sequence of impacts associated with doing the wrong thing builds up to a point where you do develop a numbness to the emotions of trading. I certainly, I rarely look at my screens, maybe once a week. My head's in research. I'm very confident with my strategy. These are things that they might have been deliberate practices on my behalf to sort of remove emotions from trading, but I find that it certainly does, over the course of time, alter to the, this is where I think the Tom Basso comes in, the Mr. Serenity. I don't think it's always been the case with Mr. Serenity, because I remember Tom Basso was thinking back to the silver trade that he missed, which was one of the biggest mistakes of his life. These are major, monumental learning decisions. And I think over the course of time, the experience tells you that it's best to have faith in your system and just keep your emotions in check, and just don't, if you find your emotions start flaring up, it's telling you something, that you're either trading too large, reduce your bet size, that if your emotions are playing up, it's telling you that you either don't have faith in your system. There are all of these things, but it's telling you there's a problem. And the more and more I've sort of adopted faith in my systematic rules-based process, the less times emotion flares up. Even during times I'm in drawdown. No one likes drawdowns. I don't like drawdowns, but it's an inevitability, and I just don't stress about it.
But in terms of,
and I think that if we do something in a discretionary, non-systematic way, I think there is no reason to do this, because it's not repeatable. Even if we are in a profit because of emotional discretionary trade, we are in a situation, not good situation also, because it's not repeatable. And if we will do it, it's maybe sounds funny, non-systematic in a systematic consistency way, maybe. If we are non-systematic and consistent in it, we will lose all our money. I think so. I'm talking about my experience, my thoughts, my own opinion here, but I'm sure that it's so.
No, I think the data backs that up. I don't think that's an opinion. I think the more judgments you make, the more likely you are to err as a human, and it is tough to parse out what is emotion and what is deliberate thought. What is so it's tough being an R&D. I would imagine, Rich. You know, deciding when to tweak the system and when not to. But the bottom line is you're not making sweeping changes. You're tweaking the edges of the system, and as long as you're keeping powder dry and applying the same general principles, even the most basic, trend following system is going to win long term. Simply, and my dad always said, never fight a man who refuses to quit. I mean, that's kind of trend following, because you stay alive, and then throw a haymaker and you land them. So anyway, good stuff.
To Druckenmiller's credit, he frequently tells stories about his big blunders, missing the dollar trade or buying tech stocks too late and things like that. And I guess guys like that, they're going to, because of the leverage and the concentration and the lack of systems, they're just putting themselves in situations where they're going to be more emotional. I think that it's really good that you can make every trade as insignificant as possible. It's a huge psychological and mental edge that something big has to happen for you to lose money or make money. I think what's the big question though is this: would we rather be in their shoes or our shoes? Would we rather? What's going to be best for success? And I think I prefer, would probably argue that there's less random luck involved with systematic trend following, and that I prefer to do it that way. But also, I think that if you apply these principles, everyone has put the odds in their favor of success. Where I think the odds of being a fantastic global macro person who kind of looks at the charts every now and then and sees the trend and tries to stay out of trouble by looking at charts, far different than every single trade is going to be a systematic approach. You're going to be able to add more and more markets, and you can pretty much shut off your emotions because you're not predicting and you are just going to go with these trends. I think that for most everyone, that's going to it's going to be difficult to not succeed. Where I think the game they play is much harder and there's a lot fewer successes to talk about.
Okay, just a quick question. In practice, though, so how are the people here who are trading for some time? Some people more than few decades. What is your frequency of checking your account equity? Are you able to check it just at the back of the day when the markets close, or are you looking into it during the day at all? I'm just curious to hear your thoughts on that, because it's so tempting. Sometimes, because it's my second year, there's a huge tendency to look into it, in the morning and then in the lunchtime and when the markets close. But it would be much more easier, of course, if you just look into it at night and then don't look into it for the following day. Thank you.
Alp, as a very new trader and taking a single stocks long only equity fractional Robinhood experiment, because I've got all this other trend following in these mutual funds. Jerry is my biggest holding, and some ETFs. I love the idea of looking at it after the market's closed. It keeps me from making any mistakes. I'm also an options trader. I've got other programs and plays that I inquire into. And for God's sake, that stuff is so binary. It's going to win or lose based on my prediction. That's not fun. Not fun. I find a lot more fun and organic adhesion to trend following. Thanks.
All of these apps, Robinhood and the like, they're all designed to play on your dopamine anyway, and nudge you to make trades and heighten your activity. Here's the biggest winners of today and the biggest loser. I when I was running money, I swear I looked at it once a week, and I considered it kind of like sinful, like pornography or something, to look at Yahoo Finance. But yeah, I don't know. That's maybe I'm a weirdo, but
No,
I don't know. I'd love to hear how often Jerry looks at it.
Oh, well, my opinion is you're not a weirdo. But I think, I look at my performance once a month when I see the newsletter that someone else writes. I told this guy who writes the newsletter, he actually put in there put in there last month that we lost money in our stock longs and we lost money in our stock shorts. I'm like, why did you do that? Why do we have to admit to such a thing? Um, but what I'd like to do is I have on my desktop I do look at the charts multiple times during the day, and then I look at the ATR moves per market. I can scroll through the charts, and I have a study that tells me how much the market is moving in terms of ATR. So I want to make it as academic as possible and get away from the absolute numbers or percentages. Sometimes I'll scroll through at the end of the month, the different to see how the days went and how we were down a lot, then we made it all back, or vice versa. But I read, that book, Fooled by Randomness by Taleb, and somewhere in that book, he said, don't look at your performance. Don't look at your daily performance. Don't pay any attention to it. And then I was like, great, I'm not going to do that. And ever since then, I've never done it. I will get notices sometimes, and over the years, from people who work at my company that, hey, you should probably look at performance. It's really bad. But I think you want to stay away from that as much as possible. And like Richard said, if you're having these issues, if life is really tough, you're probably overtrading.
Jerry, it's funny that you mentioned about that newsletter because Druckenmiller, he said, that in the NASDAQ period, he recognizes that he lost money when things were going up, and then he lost money when things were going down. And the important thing for me was that at the end he said, and then what did I learn from this? And he said, I learned nothing because I already knew I was going to lose money, and I already knew that I was going to do what I did. And that's human emotion. And that's why I think trend following will always work. Because if people like him does that, what's for the rest of us? And I think that emotion will be always over any other any other factor in markets. Maybe it will change the timing of emotions coming and going, but I think that's really revealing. If a guy like him or Charlie Munger and Alibaba do what they do, I think every one of us is will be victims of that forever.
That's a great point. I think I agree with that. What did I learn when I lost this money? I didn't learn anything new. I learned that when you go against the conservative and systematic trading, maximizing diversification, having a risk budget that's moderate, not going with the trend, adding too many parameters to your system, then that's what has happened to me as well. So I think it's kind of sad. I mean, I pretty much added to my systems over the years to be longer term, and that's pretty much the only value add. So many of my research projects I implemented, and then I had to reverse it because it went against the basic principles of letting profits run and being maximally diversified. I think getting out of, I'm becoming more and more sure of, and I think this is a very deep subject in some regards because I'm in an incredible minority on this I've never heard too many people say this, but I'm becoming more and more convinced that it's a huge mistake for systematic traders or systematic trend followers, especially, to ever trade indices. I'm so against these indices, and I'm going to eliminate them. I added them back as short onlys, but I'm going to do more research on finding better single stocks to short because I want to have more of a balance and more of a long short possibility like I do with the other sectors.
Just to let you know, so I was shorting short indices. Now I'm shorting large caps. You know, I can go long small, medium, large cap stocks, obviously, but you know, for shorts, shorting some of the large caps make a lot of sense because they are, you know, very diverse, like the indices. So the only difference is they sometimes slightly generate better returns, but short side of the equity trading is just not viable. You know, if I'm going to keep the same universal parameter set, which I am at the moment, so everything else, so stocks long only with the large cap stocks and the indices combine going short. So yeah, so that's what I do. Thanks.
Jerry, I wonder if this is a quest to get your hands on the thing itself versus the mirror of it, the shadow of it, the replication of it. You know, in an index, you've got so many pieces in it of which you've got no control. The index is running the control, and you have no control on that. What do you think?
Well, I'm not sure if I understood your question, but for me, I just can't bear to put one of these index trades on when I know the components. Not all of them are going in the same direction as the index, and some of the stocks, if I want to short the S&P or short an index, I should have been short months ago, and some of them are in uptrends, and some of them might coincidentally be signaling a short at the same time the index signals a short. But then I can't size the trades like I want to independently with using that market's ATR. I just don't think it's a legitimate trading vehicle for trend following or systematic trading. There's no reason to do it. I mean, I can think of one or two reasons to do it, but I think that if in your mind you see any benefit to trading indexes, that's a good research project to recognize the illegitimacy of applying an approach to a basket and figure out how not to do that and achieve similar results. Yeah. So one of the things that happens is that in a basket, okay, just for instance, you can have 50 stocks and in a basket, let's say. And so the ATR in that index is going to be a lot smaller than, well, it's going to be small due to the fact that those 50 stock, part of the calculation of the ATR of the index is being influenced by the diversification of the index. So you can short that particular index with a greater position size than if you traded all 50, because you're sizing all 50 individually based upon each one of those ATRs. So you have X shorts on, total them up, and you have X. Well, if you put it into a basket, into an index, you can short maybe effectively 2X, because the ATR is being influenced by the correlation, the lack of correlation, the diversification properties of that index. So I could say to myself, which I have, oh, I prefer to short the index, but really bothers me that I shouldn't be short an index because some of those stocks I know better. They're in uptrends. And so I cannot bear to short them. And yet
Better.
I want to figure out how to overcome that issue with them, which I don't think is a legitimate issue, to close your eyes. I mean, why not trade a basket of currencies? You can put on bigger positions there as well.
Right.
Okay, so
But Jerry, doesn't that invalidate trading ETFs also?
Very good. Yes. However, now I'm not going to disagree with you too much on this. But yeah, ETFs, stock ETFs, exactly. Okay, but I have said that I trade bond ETFs, or interest rate ETFs. So I think to some degree there is an issue there as well. However, there is also to some degree an issue with bond futures because it's not a single bond. And there's multiple types of bonds that can be delivered on that futures contract. So I think that there is an issue there. And so I'm not going to be able to be 100% pure because if you told me that in those junk bonds, that high yield ETF that I trade, that there is a lot of diversification there and you should be trying to find the individual junk bonds to trade, I would probably say, yeah, you're right. And hopefully one of these days I'll be able to do that, but I'm going to keep trading HYG or JNK. But yeah, if it's a stock index, I agree totally. And what I've done recently is gone out and looked at the holdings of these ETFs and the constituents of these popular indices, and then started analyzing the stocks in them and putting some of those on my trade sheet, my portfolio list. And I'm just trying to wean myself off of shorting stock indexes.
Yeah, but for example, on the junk issue, junk bonds are very similar to equities, especially when there is a bear market, and then you will have the same issue that you had about ATRs with them because it's. I mean, I understand if you're doing an ETF of gold or whatever instead of the future, but if you're doing a junk bond, you will have many different companies with many different trends at the same time, and you will be averaging for example, the ATR for the whole ETF.
No, I agree. And I think it depends a lot upon, like I said earlier, when you have these moves, and we'll just use junk bonds as an example because it could be applied to the other ETFs, which are TIPS, corporate, mortgage backs as well. Okay, so here's the issue. The issue is when you have an interest rate move, are you are all those junk bonds going up? Or when you have a stock move or a stock move down or up, a fair amount of stocks you wouldn't be surprised that are actually going the opposite direction. So when the junk moves or when these bond ETFs move, is it fair to say that not every one of them is going down or some are going up? So that's what I complain about. The ATR thing is actually a big benefit because I'm all in favor of loading up and having a bigger position due to the ATR being small. It's just I don't like it when there is dramatic diversification in that index that is driving the ATR lower. And that's what happens in stock indices because the individual stocks, if you size them based upon their own ATR, you would have dramatically smaller position than if you used the same stocks in an index because of the diversification benefits. And so that's what I don't like. I don't want to be long in a downtrend and short in an uptrend, anything. But my guess is it's not quite that bad in an interest rate ETF.
Okay, I see. I was also looking at, for example, the EMB one, the one that's about Latin American emerging markets debt, and I was wondering if that doesn't also average itself out, because you have things like Ecuador, Argentina, Brazil, Ukraine, etc., inside of it, and so they are. I mean, being related to interest rates, I see how they are similar in one way, but then the underlyings are so different, even in the durations of the bonds, that I'm being afraid that they have the same problems of something like the S&P.
Yeah. So once again, My practicality is probably going to overrule my theory, and I'm probably going to keep trading them. Yeah.
Jerry, is this a good time to ask you about ATR and how you measure it? My sense is I have a 14-day ATR, and when you say you're watching ATRs, what are you meaning? What's your spec?
You mean you use 14? How many days do I use?
I think so. When you're saying ATR, when I say ATR, I mean 14 simple days. When you say ATR, what do you mean? Or what might you mean?
Oh, I use something different than 14, but very close to 14. So I think it probably doesn't matter a great deal which one you use. It's way more important just to be consistent and don't change. I did an ATR study recently to sort of see how sensitive the change in the days are, and it wasn't very sensitive. I think 15 to 25 gives about the same results. And I use different ways of measuring that. As I just don't use a back test, but there are some qualities of ATR that you should expect. And so it's pretty easy to go through lots of data to see where those qualities start to fall apart. But yeah, I think anything around 15 to 25 is pretty much the same thing. I think the most important thing, well, I like to use ATR for my setting my stop loss and the dollar amount that I'm going to risk. Oh yeah, we didn't get into that. There was a big issue with on Twitter about the. Oh yeah, I kind of wanted to get into this. I thought this was a good topic, but maybe next week about if you're down 50%, you have to make 100% back, which is not really the way I look at it. And I think that's poor money management if you subject yourself to those numbers. I think that's definitely the way the accountants do it. When they look at your performance table and they create your performance table, yes, if you're down 50%, you have to make 100% back. My point was, number one, it's not rare. It happens all the time. So it's the insinuation that, oh my God, look at the trouble you're in. You have to make 100%. How many times has the stupid S&P done that? It's been down 50% a bunch, and it comes right back and sets new highs. It goes way more than 100%. So, like, you got to be a little skeptical of how bad this is. However, I do think if you're looking at things and if you can take, like, one of the keys of trading is to try to figure out how you can make the same bet all the time. So I want to risk 1% of my equity or 0.5% of my equity on every single trade, but I want to risk the same dollar amount all the time. So I want to risk $10,000 per trade all year. And my equity is fluctuating. And so I think if you size your trades based upon this fluctuating equity, you can't do that. So if you have 10 losing trades in a row, I want to be able to make it all back by having 10 winning trades in a row. I don't want to subject myself to the math that Druckenmiller brought up. It's pure math. Yeah, I get it. It's math, but find something better. Stop trading your equity, your current equity. Keep your risk in dollars the same when you make money and then when you lose money. So you can make it back without any trouble. And that was another kind of tweet from TransTrend, I think, which is reducing risk due to volatility gives you the illusion that, I'm paraphrasing, that you're reducing risk, but you need that risk when the markets come back to get you out of the drawdown. And I think that exactly. And they're not being as explicit as I am, but I would say that's so true. And it's not a good money management. If you start trading your equity, especially when you make money, there's pros and cons of this compounding. And the con is you throw on these big positions when your equity is at an all-time high, and a lot of that profit goes away because you're following a trend following system. When the markets go down, you're going to be losing lots of money. You can no longer afford those trades. And then you have to implement all kinds of other stuff, which I don't have to implement.
But in systems like for example, the S&P 500, if you have a 50% drawdown, and as you said, it did many times, it came back and even multiplied from that. But for doing that, things have to change radically, like, having the interest rate going from almost 20% Volcker levels to zero. So at the end, it looks like it's healthier to recover from something that you keep doing the same bet over and over again, although maybe it will take you more time, like for example, trend following strategies compared to something like the S&P. And also you have the S&P, but you also have the Bovespa index and the Russian index as another alternative. Because if not, many people will say, well, let's just go passive and invest in the S&P and forget about the complexity of every alternative that I have.
Yeah, one of the really secrets of trading is trade level calculation. And you can make life very easy for yourself if you have a conservative trade level that doesn't change very often. Doesn't change when things are great and doesn't change much when things are bad. At some level, that's going to fall apart, because if you do keep losing money, you can't trade at the old trade level. You're down too much. You've lost too much money. So the logic does fall apart. But the key is to have a system that that is better, and then for your initial risk budget to be more moderate. I think it's a huge edge. And that I remember that one spaces we had with Bruno number 2 from Italy, I think. And I just said, when I was talking, I just said something like, Sharp is not correlated. Volatility and Sharp are not correlated with drawdowns or risk. And then a few minutes later, he said the exact opposite. And then I was like, well, Bruno, I really like you. And so I think I just said the opposite of what you just said. So I'm trying to think of a way that we're both correct. And might it be that the reason I'm correct is because I don't use current AUM as my trade level. I use realized profit, realized equity, and then I don't change it very often, and I keep it somewhat constant for as long as I can. If I make too much money, I'm in a bad situation. I've got to change it. Wow. Okay. And he's like, yes, exactly. If you use AUM as your trade level, then yeah, volatility and standard deviation are good indications of drawdown, but not if you've cracked the code. You're cheating. You've stepped outside of regular finance, and you've changed the way that you look at risk and how you calculate risk. And I think that is one of the huge keys. I mean, I'm all in favor. I'll never be one to say anything like, people say this all the time. All you want to talk about is entries and exits, and entries and exits are not that important. I think they're incredibly important. I think every element of the system is equally important. I mean, who wants to slack off and just declare some elements of what you do? Exits are way more important than entries. Whatever. I mean, I don't even look at life that way. They're all important. I'm going to give all of them my best shot. However, one thing that never gets talked about is the way you calculate that trade level and how you want to section off by trend following demands that you treat losses, winners and losers differently. And I think it's reasonable that it also demands a different calculation for capital, that it does not equal your total equity.
And this is kind of, a funny appreciation. But do you get nervous the day after you update that value of the new closed equity near those days?
Well, I'm always a little bit nervous, but just to be clear, though, you know, I have an average holding period for 1 year on a trade. So I've got trades on now with that go back to 2020. And so those trades were based upon another trade level. And then I had a trade level in 2021, in 2022, in 2023. So the trades that are going to be impacted by this new trade level are just the new ones, the ones coming up. None of the old ones are being touched because they have a different trade level, and we keep track of that. And so, once again, when you put that trade on, not considering you're going to get capital additions and redemptions, you obviously have to adjust for that. But when you put those trades on, you do not touch them. These are system trades, and I don't want the system to be polluted by random rebalancing based upon new trade level, new profits or losses. So I'm doing my best to keep them constant and not adjusting them, and unless it's an entry. So it's only a small portion of the trades, the new ones coming up, that are being impacted by this trade level. And I trade 4 systems, so maybe one trade has a trade level from 2022, and another position on the same market has a trade level from 2023, because that's when that entry occurred. So yeah, I'm not that afraid.
Yeah, things don't step up on the next day.
Jerry, can I ask a question about your 4 different systems without specifics, just general theory? When your first system triggers an entry, it's associated with the exit from that system, and it doesn't switch systems, right?
Right, each system has its own entry and exit rules, so they
Thanks.
just behave independently. The ATR could be different, obviously on the different systems. Exits are going to be different. I can be long and short the same market. Yeah, so it's all there. So people ask me all the time, don't you average up? Don't you pyramid? And I'm not afraid of being characterized by that. I just think that it's not that accurate. So you want to really be more accurate and understand what's going on. You just treat these systems independently. They don't know that they're not influenced by the other systems. One thing that we do is that if one system is losing money and another system is making money, we don't really take that in consideration as it relates to trade level. The trade level is all determined by the overall equity in the trade level, not each individual systems. System 1 may need some help from System 4 sometimes, so System 1 needs to borrow some equity. It's always getting an equal share of the total equity, even though System 4 is doing better. I definitely don't think that you should reward System 4 for doing better by giving it bigger position sizes, because that's probably just temporary. It's doing better.
Yeah, and this keeps you from unnecessary overweighting.
All right, I'm going to go get ready for my fishing trip, unless anyone has any more comments or questions. And I think we're going to do, I'll send out a notification, obviously, but we'll do a Thursday again next week. But I'm giving you more notice. Sorry about the short notice. But does anyone want to take us into the next 13 minutes? Anybody want to ask any questions? Billy's one of my good friends, but he never talks. He just gets off and starts sending me a lot of messages. He and I enjoy each other. Maybe one of these days we'll actually meet. All right. I don't hear anything, so I'm going to say goodbye. Have a good weekend, everybody.